Hello and welcome to our weekly market roundup, your one-stop source for the latest in global market trends, key economic insights, and top financial news. I'm your host, Daniel, bringing you the highlights and the happenings from around the world. Let's dive into the numbers and stories that moved the markets last week. Global equity markets rallied this week, with U.S. stocks climbing on expectations of a Fed policy shift and European markets rising on easing inflation concerns. However, Chinese markets declined as weak inflation data raised fears of deflationary pressures. In the U.S., the S&P 500 rose 2.8%, while the Nasdaq surged 4.7%, thanks to a strong performance by AI-related stocks. The Dow Jones, though slightly lagging, managed to gain 1.9%. European markets were also in the green, with the Stoxx Europe 600 index advancing 1%, Germany's DAX rose 2.2%, France's CAC 40 gained 1.5%, and Italy FTSE MIB rose 0.8%. The UK FTSE 100 rose 1.1%. In Japan, the Nikkei 225 was up 1%. Chinese stocks fell last week as weak inflation data raised fears of a potential deflationary spiral. The Shanghai Composite Index and the CSI dropped by 2.2%. In Hong Kong, the Hang Seng Index lost 0.4%. The yen strengthened by 0.7% against the US dollar, closing at 141.5 as safe haven demand rose amid uncertainty in global markets. The pound and the euro remained stable, closing the week essentially flat. Oil prices increased slightly, with Brent crude rising by 0.8% to $69.84 per barrel as concerns about supply cuts outweighed demand worries. Gold continued its rise, climbing 3% as market volatility and geopolitical tensions drove investors to safe haven assets. U.S. inflation showed signs of further moderation, with the Consumer Price Index falling more than expected. This fueled speculation that the Federal Reserve may pivot to a more dovish stance soon. The yield of the 10-year U.S. Treasury bond sank to the lowest level since June 2023. The European Central Bank cut interest rates again, but gave little guidance on future actions. The ECB remains cautious, balancing slowing growth with persistent inflation concerns. In the UK, GDP stagnated and pay growth eased, dampening expectations of further aggressive rate hikes by the Bank of England. While headline inflation forecasts remained unchanged, core inflation was revised slightly higher due to stronger services prices. Recent comments from Bank of Japan officials suggest more rate hikes could be coming, with one policymaker indicating the short-term rate might need to reach 1% by fiscal 2026 to control inflation risks. Despite this hawkish tone, 10-year government bond yields dipped slightly to 0.8%, tracking U.S. bond movements. On the economic side, Japan's Q2 GDP growth was revised lower to 2.9%. Inflation slowed to 2.5% in August as a stronger yen curbed import costs. China's CPI edged up modestly, but the producer price index remained in negative territory, highlighting the country's struggle with deflationary pressures. Additionally, export growth forecasts were revised upwards, giving hope that external demand might help stabilize the slowing economy. Here is what to keep an eye on this week. That's a wrap for this week's Market Roundup. Thanks for tuning in. Be sure to subscribe and hit the bell icon to stay updated with the latest market news and analysis. Until next time, stay informed and stay ahead. I'm Daniel, and I'll see you next week.